Good morning. I'm Holly Brook, and I lead the valuation department or valuation team here at Adams Brown. I'm credentialed in valuations with the ASA, and I have 20 years of valuation experience under my belt. But one of the parts that I love about working with our clients is that we get to interact with business owners every single day. And I get the opportunity to talk more with them about their strategic plans and things that are valuation related topic. We'll talk about some of those succession planning tips and tricks that we have learned along the way, and also how to help you unlock the fair market value of your company's equity.
Thank you, Holly, and good morning, everyone. My name is Sean Kennedy. I'm a principal with Adams Brown and currently lead our advisory services department, which includes, amongst business valuation, our M&A advisory arm, our forensic and litigation services support wing. And just like Holly, we have a strong personal and professional passion for this topic. It's fun. It's fun. It's an opportunity to drive value for clients and stakeholders, and something that's really kind of fits that nice blend between complexity, challenge, service, partnerships, and then ultimately unlocking value for all parties. So we're going to talk about, Holly's going to talk about today, about kind of, our approach, our valuation, and then I'll come in on the back end and talk about how really to take your valuation and how to interpret it, how to use it within the course of your business with some case studies, some best practices, and then we'll wrap up with a little bit of Q&A on the back end.
Yeah, we'll get started with our first two polling questions. Is your company going through a growth cycle? This is one of the key inputs in valuation, so we're going to be talking a little bit more about that, but just let us know where you're at in terms of your company's growth. The one of the key parts of valuation, and especially if you are a business owner, you probably hone in on your balance sheet. And so we're going to be talking about what that fair market value of the company's equity looks like. We're going to jump into another polling question, but the answers here that we received, about 63% of us are going through a growth cycle in their business. The second question, is your company the target of an acquisition? Or also maybe you're considering acquiring another company? Let us know in the polling questions. One of the things that I hear talked about really often from business owners and business brokers, I think it's kind of they've coined that term, is blue sky. And also looking at pricing multiples. But so in terms of the polling question results, not many of us are the target of an acquisition, but some may be considering that in the future, about 23%. That's really exciting, and there's a lot of opportunities for the company and the owners to unlock the private company wealth. Right now, you're looking at pre-liquid wealth. So looking at that balance sheet, you're probably honing in on what's the book value of my shareholders' equity. That's an accumulation of your contributed capital, your earnings that you've accumulated over the years in business, less any distributions that you've made to shareholders. However, this amount doesn't necessarily translate into what the fair market value of your company is actually worth. So we'll be talking about how we measure that during the business valuation process. But generally, what we're doing as a valuation practitioner, I'm looking at that shareholder's equity. I'm determining the value of that shareholder's equity. The difference between book value and fair market value is your implied goodwill and intangible assets on your balance sheet. So anything over and above the book value of your equity is your blue sky or your intangible assets. So why is this important? It's important to understand that you want to, as a business owner, make sure that those goodwill and intangible assets, I'm talking about customer relationships, internal processes, specific know-how that you have above your competitors or your competitive edge. Also, whatever research and development you put in the company, that's part of your goodwill and intangible assets. However, you want to make sure when you're considering the succession planning process that that is transferable to the next owner. So if I have a lot of key relationships, but they're dependent on me as the business owner to manage those and keep those clients happy, I'm limiting the value of my particular company and I'm limiting the worth that's transferable to another owner. So if there are some gaps in that transferability, it's important to fill those gaps. First and foremost, it's important to look at your company holistically. And valuation, we use a holistic approach, looking at not only the company's financial performance, but also we look at projections, we look at the economic conditions and the outlook of the economy. We look at the industry and its performance over time. We also look at kind of those risk factors that go into the business valuation, which are key relationships, key leader dependencies, customer dependencies, supplier dependencies. During COVID, we learned a lot that, relying on one specific supplier may not have been a very good avenue for us. In valuation, we also look at the restricted nature of the legal agreements that the company has in place. So in our valuation report, I'm going to talk about later, we're telling a story. We're telling this story from a business owner's perspective, and we are considering how that's meaningfully translating into the company's value. One thing to note about valuation, it's always going to be forward-looking. We are going to look at past performance and comparison to the industry, but we're always looking at it from a forward-looking basis. With that, I'm going to launch into the third polling question. Have you or your company ever had a valuation performed in the past? If you have, you may know that there are 3 different methods or 3 different approaches, and underneath those approaches, there are different methods that we apply. Just going to wait until the polling question results come in. So about 32% of you have had a valuation in the past. Some of us haven't, and that's great. This is a good introduction of what that looks like and how we go about the process. So there are really 3 key inputs, and in every valuation, we're looking at these levers of valuation, I call them, or 3 ingredients to the valuation. It's cash flow, risk, and growth. And so we're looking at the cash flow that the company is generating to the owners, and we're also looking at what's that normalized or recurring cash flow that's distributable to the owners. We're also looking at what's the growth potential of the company and how does that translate into value drivers. We're looking at the associated risk with owning that investment or owning the equity in that company. And so we're doing a risk assessment. We're generally applying that through the income approach and looking at that through the lens of a prospective buyer. How risky is this in comparison to maybe an industry peer? How risky is the industry that they're in? Do they have some diversification? So all of these factors are going into the business valuation. So in terms of the main valuation approaches that we're going to use, we are generally looking at the income and the market approach. So we have a couple of articles that are coming out specifically discussing the income and the market approach. These will come out later, probably in June or July, and it'll give you a better understanding of what those methods under the income and the market approach look like. But from a very high level, we are looking at the income generation capability of the company, as well as what are other transactions or market, what's happening in the market. Also, looking at different types of transactions. If it's a rather large company, we might look at the guideline public company method. Generally, we're going to stick to the guideline transactions where we can find transactions of similarly sized and similar to the operations of the company. There really is no perfect match, but it gives us an indication using pricing multiples. Probably everybody's heard of price to EBITDA. That's one of the most familiar multiples that we use in the market approach. And so we are looking at companies that are similar to our subject company, and then we're applying that multiple to that. I'd like to talk now about what goes into the valuation report and how we report our findings. But first, I'd like to discuss the process. So when you are obtaining a business valuation report, the first step would be to get an engagement letter signed first and foremost. Also, there's going to be some information that we request. This is going to be inclusive of the company's past 5-year financial history. It's going to include the legal agreements, anything that's set up in terms of the company's organization documents. If there's a buy-sell agreement, we look at that as well. And then we also, like I said, take a holistic approach. We look at the economy and the current economic conditions, as well as the industry performance. We also take a look at the company, how they performed in comparison to peers. So all of that goes into our valuation report. But when we're reporting our findings, we generally stick to 2 different reporting levels. So the first level is a calculation of value. And then the second, which is a higher reporting level, that's going to be your conclusion of value. So a couple of questions that we ask in order to determine, what kind of report we would need to issue and what reporting level is sufficient in the valuation. We want to understand the purpose of the valuation. We also want to understand who the end user of the valuation is. So if the valuation is going to be shared with somebody externally, like a third party, then we would need to move up to that conclusion of value level of reporting. However, if the valuation is going to be used internally by the management team, we're able to use a calculation of value. And that's generally something that it's a more concise report. It's delivered written, but also we deliver part of the report orally. And then the conclusion of value is just going to have a lot more information. It's very robust. It's generally about 70 to 80 pages. And so the report writing time takes a lot more in terms of what goes into the report. Just a little overview of kind of the timing and pricing. Our calculation of value reports are going to be much less in terms of the price compared to the calculation of value. And then we're also looking at a 3 to 4 week timeline to get the report finished on a calculation of value versus conclusion generally is about 5 to 6 weeks out in terms of timeline. Let's jump into our first case study because it's a good one, and we are really excited to share these real world examples of how the valuation, which is generally it's going to be the first step in the succession planning process. So in this example, were um, we were consulting with dad, and he has two sons that are actively involved in the operations of the company. So this is a generational transfer of ownership. The key parts of this are dad wants to make sure that the management team, the business continuity, everything, the company is in good hands. He also wants to strategically set his two sons up to be very successful. His goals also were to be a very good steward of the company until his sons are ready to step into that leadership transition. So we provided a calculation of value. It's basically setting a baseline for the company's value, and we're going to generally you can do a staged gifting type of strategy or also a selling strategy or a combination of the two. In this case, dad wants sons to have ownership in the company. There is an ownership mentality. Whenever you are an owner of something, you're a much better steward of that. And so he wants to make sure that they're stewarding the company well, that it's going to succeed long after him. As well, he's looking at gifting minority ownership of the company and doing that in stages. So in this approach, we're looking at a combination of gifting and selling. So what are some of the things that we considered in this valuation? Well, we have to consider for a gifting strategy that the standard of value in a valuation is fair market value. And that standard is different than if you were to exit the company and there was a third party that was going to buy that ownership interest. We would more likely be considering investment value. So that's a little bit different. Generally, the pricing is going to be different versus fair market value and investment value. Also, we are looking at passing on minority interests of the ownership. And so I'll talk a little bit more about how we get to that minority valuation and what that means for the company. The other thing that we considered is that this company is in a growth trajectory. So we want to make sure that we're gifting those shares kind of before that growth takes off. And so we're looking at the valuation using the income approach. We looked at the discounted cash flow method, and then we also supported that with the guideline transaction method under the market approach. Let's move to what key factors that we looked at in terms of who the stakeholders are, our advisory team, and how everything kind of played together. So we answered a few questions first. We're looking at minority interests because these sons are going to own smaller than 50% interests. And then we also looked at the company. They're going through that growth strategy. We want to make sure that we're gifting and transferring the ownership right away before they kind of go into that key growth cycle. And then we also asked, is there a liquidation strategy? Is the company going to liquidate in the next couple of years or sell? The answer to that is no. We are making sure that these sons are going to continue on with the company and that there's going to be business continuity. One of the key factors in terms of that risk, we look at, does the company actually have a succession plan? Is it in writing? Is it discussed at the annual board meetings? If so, this helps decrease the risk of the company, and that actually has an increasing effect on the valuation of the company. Another great strategy for the management team would be putting in place a buy-sell agreement or a stockholders agreement. The buy-sell agreement, it provides details regarding what happens when there are multiple shareholders or owners, what happens in the event of someone passing away, if they become disabled, if there's a divorce or a dispute between the owners. It also provides and shares information of how those shares would be valued and how the fair market value would be calculated. I look at the buy-sell agreement as a living will for the company, and you should treat it as such. You should look at it from an annual perspective and also just making sure that those parameters for calculating the value are fair to all owners. I see a lot of valuations where the buy-sell agreement has a formula, and that's not necessarily a good strategy just because economic and industry conditions could change. There could be something where when the company goes into this growth cycle, that has an increasing effect also to the valuation. I would say the formula-based approach is probably, I would use that with reservation. Let's move on and talk about what levels of value. So this is an interesting concept. It's something that is a little bit more difficult for owners to understand, but I'm going to try to distill it in a way that's somewhat easier to understand. So you have a controlling interest owner. They own, let's say they own 75% of the shares. They have certain prerogatives of control. Their shares are generally worth more than the minority shareholders. And so we look at what the company is generating in terms of what are those controlling adjustments, if there are any, and also if we need to make adjustments to the cash flow for the controlling interest owners, we will do that in our analysis and approaches. But we also, in order to get to a minority level of the company's ownership interest, we would apply discounts. So we're going to apply generally on the market approach a discount for lack of control. And then we're also going to apply what's called a discount for lack of marketability. The reason that this is important is because whenever you're doing a gifting strategy, you want to incorporate those discounts so that you can actually pass on more of an ownership interest in that company to the next generation. I think that covers a lot of the minority and control issues. Also, we want to look at what the liquidity looks like and how that's affected. That is going to be interpreted through the discount for lack of marketability. And so let's just say I own shares in Apple and I could dissolve those shares in a relatively easy timeline. For a privately held company, it's not necessarily something that I could do right away and get my cash. So that's why we would apply that discount for lack of marketability. With that, I will turn the presentation over to Sean.
Thank you, Holly. That was excellent. Really appreciate your oversight. And just a quick heads up for everyone, for the best interest of time, we're going to keep this pretty high level. If you have any further follow-up or want more in-depth conversations, please reach out to us separately. We are more than happy to discuss this work. We're both nerds at heart. We love this topic. We love speaking about it. So please reach out. It's not an inconvenience. So to recap, Holly just went through a great overview around Valuation 101, what to do, how we do it. Now it becomes, how do you take a valuation? How do you apply it to your business? I thought an interesting polling question wasn't so much I'm looking to buy or sell, but I'm looking to expand or grow. Valuations can be used very, very usefully in this realm, not just buying, selling, gifting, minimizing your tax obligation for estate purposes, but for strategic planning. So keep that in mind as we talk about how to interpret your value. So very high level. On the left, as Holly mentioned earlier, 3 inputs: cash flow, risk, and growth. We also believe there are 3 common factors for each input as below. The first one is quantitative factors. These are pretty self-explanatory. This is your revenue, your profitability, your free cash flow. It's also your quality of assets. If you have AR, is it current? Is it 6-month-old? If you're in construction, what's the current condition of your over-under WIP? Your work in process. Manufacturing, is your inventory new? Is it getting turned? Is it 30 years old collecting dust? Quality of assets is also important for your quantitative factors. Secondarily, you have your qualitative factors. Holly had touched on this a little bit earlier with goodwill. This is, in short, this is your people, your processes, the use of your software and technology. It is your key management and leadership, and it's your culture. Easy rule of thumb, qualitative factors equal enterprise goodwill. It's not a 1-for-1, but a key driver. And depending on your industry and your company, enterprise goodwill can make up the majority of your company's valuation. If there's one thing to take away from this, when you're assessing the value of your company, focus just as much time, if not more, on qualitative factors than simply revenues, profits, and cash flow. They are tied together. Then lastly, chutes and ladders. What does this mean? Remember the board game Chutes and Ladders? Save a cat from a tree, climb a ladder, break the cookie jar, go down a slide. Well, the same holds true for companies. It's not just premiums and discounts, but it's what other key features or factors are relevant that can cause your company to either go up in value, the ladder, or go down in value, i.e. the chutes. These can be things such as the current situation of your industry. Is it an expansion? Is it being impacted right now? It can be your location. It can be if you're ideal for someone as a roll-up target. Can you be leveraged and can you realize economies of scale? How capital intensive is your company? Are there barriers to entry? What's the regulatory environment look like? Along with just control factors and marketability and liquidity, these chutes and ladders are maybe not the most pressing form of value, but they're equally as important, and sometimes often mean the difference between getting a 7 or an 8 valuation in terms of a multiple to a 9 or a 10, or maybe going from a 5 to a 7. So they can impact valuation considerably. So with that said, we can move on to the next slide and talk about how we've applied these factors into a relevant case study. For everyone, as an FYI, this deal is currently being finalized and under negotiation, so we are keeping everything confidential, but being mindful that we can't give any more in-depth comments on this topic. But a couple of months ago, we were reached out to by a current client, came to us who said, hey, we are looking to sell off a division of our company. We have received an offer for a price of X. We'd like your team to do a valuation to help us kind of substantiate and get a good, is this price appropriate? So we did. And when we looked at our key findings, we found the following. Quantitative factors. This company had grown considerably over the last 5 years. It had also grown during COVID. Not only had it grown, but the revenue mix had shifted from one product to multiple products, one of those being recurring revenues. Very, very important feature. Getting back to the last slide, chutes and ladders, customer concentration right now is a key emphasis on underwriters, banks, buyers, sellers. It can hold up deals. It can cause value for deals. But they were able to diversify their products, still maintain excellent margins, and the quality of their assets. It's a cash-heavy business. They don't have any AR. It's cash in, cash out. The quantitative factors were excellent, as were the qualitative factors. The founders were still heavily involved in the day-to-day operations. This division had been successful for over 20 years. There was great brand recognition. We also liked the fact there was a national buyer group in terms of customers. We also liked the fact that they had key partners in the form of vendors or customers that were very, very vested in the success of this division. So because of those quantitative factors and the qualitative factors, we were able to substantiate a value of this company that was nearly double of what the offer price was. And not only double it, but we were able to substantiate and communicate why we felt the value was what it was. However, while those factors were great, in this situation, we've also identified more chutes than ladders that can impact the value. There was key person risk. Upon sale of this division, there was, to Holly's point, there needs to be some transfer of goodwill from the current owners to the new owners. The buyer group for this division in terms of marketability is pretty limited. It's a pretty niche market. It still is something that's been used, but it's also discretionary spending in terms of this division and the services products provided. So in economic times that are tough, they may see people pull back. So while the factors were great quantitatively, qualitatively, we did identify some key risks or some chutes in this situation. So what we were able to do is we found an interested party who had offered the price. We countered with one that was significantly higher, but our conclusion was we can support the value. We think it is this. We also know the risks that are associated with this price. So the difference between your value and our value, we're going to structure within the terms and conditions in the form of a more expanded earnout period, where it's more incentive or performance based, where the owners have the chance to sell and then participate in valuation and earnouts on the back end, provided they can transfer goodwill and ensure that the company is successful or this division is successfully transferred. So a good example, very high level around looking at 3 factors with our 3 inputs, getting a great value that we could support, negotiate, substantiate, and then ensure that all parties worked out pretty well. So with that said, my last slide, kind of 4 best practices. This will be shared for everyone, so I'll go pretty high level. This is our opinion, 4 of the best things to think about. We're going to focus more on the sell side because we do a lot of sell side work, but also for buyers as we do work with buyer groups as well. First and most important thing, bad data kills deals. Financial information that doesn't reconcile or overall is incorrect is the leading killer of deals amongst business owners. And we here at Adams Brown are committed to eradicate the world from bad financial data. But in all seriousness, if your information is incorrect, not accounted for, good luck. Buyer gets that. Not only they sit there and say, well, we can't trust the numbers. How can we trust the operations? Confidence is wrecked almost on the spot. Before you go to market, get your information cleaned, presented so that it can be valued appropriately. Number two, be honest. This goes for all parties, buyers and sellers. Mainly for sellers, you have to be upfront and honest with everything going on concerning your company's financial performance and underlying operations, even if it's not good stuff. A smart buyer is going to do their homework. They're going to find it. But more importantly, they are not oftentimes looking for perfection. They understand that all companies have issues, gaps. That's why they're looking many times. They don't want something turnkey. They're looking for upside. But if that information is withheld, misrepresented, or just blatantly false, it's going to get caught. It's going to squash a deal. Number three, pigs get fed, hogs get slaughtered. For all parties, the goal is not to get the best price. I'm going to repeat that. The goal is not to get the best price. The goal is to get the deal done, find the right fit, and have all parties be happy with the outcome. Why do we say that? It's because we have to be realistic. All parties are going to do their homework. They're looking out for their best interests. And in the current climate, people are willing to spend and pay a premium for good stuff. So it's not a matter of just, I'm looking out for my own best interests. It's find the fit, get the deal done, make sure it's happy, and you're satisfying all parties, buyers, sellers, banks, insurance, any other key stakeholders associated with the deal. Lastly, we see this a lot, especially for sellers. Selling a business is exhausting. Letter of intent is brutal. It's stressful, it's expensive, it's time consuming, it's chaotic. You're running a business, you're trying to sell, and you can't talk to anyone because you're under NDA. All right, it is brutal. It is like planning a wedding. That's kind of our analogy for it. But don't lose sight of why this is going on and the fact that you are exiting a business and that you are beating the odds, you are finding a buyer, you're selling your company, and in many situations, creating a windfall event that could be life-changing for your family and future generations. And if you focus on the stress and just how tough it is at that time, it is going to rob you of the benefits and the joys on the back end once it is done. So most importantly, when you're going through this, buyer or especially a seller, yes, it is brutal. It can be costly. It can be time consuming. We're planning an awesome trip. There's multiple legs, but we're going to end up in an awesome destination. So do not lose sight of that. So with that said, best practices. Holly, I'll throw it back to you to kind of help recap and conclude this item, this presentation. Holly, I think you're on mute.
Thank you. I'm so sorry about that. I think as we've communicated, valuation is one of those key components, but it's also a great first step when you're thinking about your business succession planning. I leave you with a quote because I love this quote. It's from Chris Mercer, and he wrote a book about unlocking private company wealth that our team is going to go over this summer. But, you know, your company is with you today. Someday, perhaps a long time from now, you're going to sell it. Today, that shareholders' equity is pre-liquid wealth. But there are many things that you can do in the interim to manage your pre-liquid wealth. And so I hope we've given you some tips, tricks, strategies, a better understanding of how that valuation works, what those valuation drivers are. But also one of the things that we do in our valuation process, we love to go over the report with the client once we've issued the draft. And so we're talking about those key assumptions that we've made in the valuation. We're talking about how that's driving the growth. We're talking about how that's impacting the value of the company so that the owners can get a better understanding of how to manage that interim wealth. A lot of small business owners that we talk to, their investment in their company is one of their largest assets. It could be one of their only assets for their retirement planning process. And so you are managing that asset like you would manage an investment in a portfolio. We want to help clients understand what's going into that valuation and also teach them on some of these valuation concepts. It's one of the most enjoyable parts of my job. And also, Sean and I get a real kick out of meeting with the clients and getting to know them better and understanding their business and what drives them. With that, I'll go ahead and turn it over for question and answers. We may have another polling question too. Wow. I hope that everybody says yes, that you learned something from this webinar, because we did not do our jobs well if anybody says no. So lots of pressure there.
All righty. Thank you, Holly and Sean. I'll just give it a moment for everyone to have any questions for them to type in the Q&A box. Again, just give it a moment. If no questions come through, we'll go ahead and wrap up early.
One of our first questions are, how long is the valuation good for? That's a really important question, because when we're looking at the valuation, we're looking at it at a specific date and time. So we clarify the valuation date. Generally, I like to put that valuation date fiscal year end, or something that's meaningful to the company owner, but also because that valuation date is static, the valuation generally, I would say probably 6 months to a year. If there have been any meaningful changes in the cash flow or the operations of the company, then you may have a more limited window for that valuation. We're also recommending, if a client wants to look at the valuation on a recurring basis, every other year is could be a best practice. But we try to make it simple for the business owner, and give them the right tools, and show them how to maximize their value over the interim time. One of the second questions that we have is, what are some of the biggest mistakes owners make when evaluating their business? I think, Sean, I'm going to lean on some of your input, but I think relying too much on the company's owners, to maximize that value for the shareholders, just leaning on them as a key person, but also making sure that, you're offering that ownership transfer to and doing that succession planning process.
Yeah, I'm going to jump in, Holly, too. And Mike below, I'm going to sit there and say, our valuation subjective? The answer is yes. While we do follow methodology, it is we have to follow best, required methodology. There is a formulaic approach to all. There is a science to what we do. But a lot of our input is relied upon management and their ability and the representations both today and going forward. So it's a combination of both. But yes, there is no pure definitive, this is the ultimate approach to everything. There's always subjectivity within a valuation. Above to the attendee, the biggest mistakes owners make when evaluating their business. I'll keep it pretty straightforward. I'll think of the two E's: emotion and education. If there's miseducation, I've lost track of the time someone's called and said, hey, my buddy got a 6 multiple for their business. That means I should get at least a 6 or a 7, right? And the answer is no, it's not. Because we don't know all the factors that come into play for the reasons that we've mentioned. That's the educational piece. The emotional piece is the business owners that can't be realistic. They refuse to accept reality. They are so caught up in it. Look, and we get it. There's a lot of emotion. This is your baby. This is your life. This is your lifeblood. But many times people oftentimes think, well, there's no way it's only worth that. I can clearly do this, this, and this, and this, and this. And it's, well, then why aren't you? So I get back to the biggest mistakes they make: miseducation and too much emotion.
One of the next questions we have: what strategies help minimize the value to gift the ownership to the next generation? So some of those strategies are, when we're doing the valuation, we're looking at it from an income and a market approach perspective. So we're using those two compatible types of approaches. And then we're also looking at the discounts. And so, like I said, when we're applying those discounts to the ownership interest, it has a minimizing effect on the ownership, the value of those shares, but it makes it so that you can gift more shares to the potential recipient.
And Holly, I'll add on that as well. It's not, she's correct. The application of discounts for control and marketability can really benefit in reducing the value of your company, of your gift, and subsequently your future tax upon transfer. Another important factor is timing. And yes, this is also a shameless plug. Right now, the estate exemption, I forget what the number is, but it is considerably large. It is set to sunset or decrease over the next couple of years. And this is an election year. And depending on what happens and what shakes out, it is not unlikely that if in their circumstances, which may cause the estate exemption to be lowered even further. So right now, the exemption's at around an all-time high. It's a good time to get valuations performed to maximize that exemption, if anything else, while it's still at an all-time high in terms of what you can put in there tax-free.
Good stuff. Good stuff. I'll just leave it one more moment for any other further questions that someone might have. Holly and Sean, again, thank you for answering our presentation. It was very informative. Looks like we got one more here. What's the best way to get in touch?
You can reach out to Sean and I via email, or Sean and I are both in the Overland Park office, but we have offices in Wichita, and you can talk to your Adams Brown advisor about how to use valuations in managing your company and how to use that as a best practice. So I hope that you've learned a lot in the limited time that we've had together, but we really enjoyed presenting to you today. So thank you.
Thanks, everyone. We appreciate your time and have a great rest of the day.